Hi, my name is Lisa Cummings, and today I'd like to share with you some information about cash balance plans. Specifically, today I would like to focus on maximizing tax deductions for an organization and how that can be beneficial for your retirement savings. Before I go into a little bit more information about cash balance plans, first I'd like to share with you about our law firm. Our law firm is Cummings and Cummings Law. You can find our website at www.cummings.law. At Cummings and Cummings Law, we are a full-service law firm. We assist business owners, executives, real estate developers, families, and individuals in all of their tax and legal needs. Now, a little bit of information about me. As I mentioned, my name is Lisa Cummings. I have spent my career working with large organizations, assisting them with ensuring that their retirement benefit programs, as well as their health and welfare programs, their compensation structures and programs, as well as executive compensation needs are met to provide the organization and their employees with competitive and compliant programs. Now, let's talk a little bit about the value of putting together two fabulous retirement plans. And in this particular video, I'm going to talk about stacking these two qualified retirement plans. If you're already maxing out your 401k plan and your company is still staring at a large tax bill, there is a reason. The 401k plan has ceilings. These are limits that are put in place by the IRS. The IRS annually will review how much an employee and the employer can put aside into a retirement plan in that year. For many profitable professional practices and closely held businesses, the most effective next step is not a better 401k. Yes, your 401k plan needs to be efficient. It needs to be maximized to the extent that you can defer within that particular plan. But then the next step is a stacking strategy. That is, keep the 401k plan as the foundation and then add a cash balance plan on top of that particular 401k plan to create much larger deductible contributions. In this video, I will share with you how this combined approach works, why it can produce substantial tax deductions, and what you need to do to get right so that the strategy itself is both sustainable and compliant. So this stacking strategy is all about first starting with your 401k plan. Your 401k plan is the foundation upon which your retirement maximization can be built. So the 401k plan foundation down here, it is a defined contribution plan. IRS has limits for defined contribution plans as well as for defined benefit plans on how much can be deferred in that particular plan on an annual basis. Let's look first at the 401k plan. The 401k plan allows both employee deferrals as well as the employer can choose to match a portion of the employee's deferrals, and then the employer may choose to also make a profit sharing contribution or a supplemental contribution on top of the employer match. And then typically down here in our 401k plan, the participant will be the one to direct the investments of that particular account. Now contrast that with a cash balance plan. So the cash balance plan can act as a booster to your overall retirement savings approach. The cash balance plan, as I mentioned, is a defined benefit plan. And the IRS also is the entity that ensures that defined benefit plans, such as a cash balance plan, operate in accordance with federal law. In a cash balance plan, there will be employer funding. So the employer alone funds the cash balance plan. There are two contributions that the employer must make on an annual basis to that cash balance plan. The first is called an employer-funded pay credit. And then the second contribution is interest credits, which will be defined within the plan itself. And then what this stacking mechanism is meant to do is to expand the employer's deductible contribution capacity beyond what a 401k plan is allowed on an annual basis. The stacking will also help owners who typically are closer to retirement, they are in later career years, to accelerate their retirement funding. And then third, this particular stacking approach will create a coordinated plan design between the two plans that balances the owner's goals and the employee cost. So the keys to doing all of this right will be first to run a multi-year feasibility study. Whenever a company decides to establish a cash balance plan, they should do so only after they have determined that on a multi-year basis, they will be able to annually fund this cash balance plan to the amount that is required based upon this particular company's demographics of the employees. So looking at the owners, how much their compensation is, and comparing that with the staff and what their compensation is. All of this will require also the utilization of an actuary to ensure that the funding meets federal IRS requirements. All of that will be taken into account when this feasibility study is undertaken. And typically, the time frame of a cash balance plan is a 3 to 5 year period of time. This feasibility study, if it ensures that a cash balance plan is right for your particular organization, can coordinate with a 401k match and profit sharing to also provide cash balance credits to the participants in this plan. So in this instance, the owners, who would also be employees of the company, would also have a cash balance credit. Another key to ensuring that this stacking works is to also plan and provide for consistent annual funding to the cash balance plan and clean cash balance plan administration. This stacking, this putting in place the foundation of the 401k plan plus the cash balance plan on top can create bigger tax deductions for the company. The employer contributions to qualified retirement plans are generally tax deductible to the business, subject to plan rules and limits. A 401k plan can provide meaningful deductions through the employer match and or employer profit sharing contributions to the 401k plan. However, at some point, the 401k plan hits the design ceiling. So the maximum amount the employer can contribute to the retirement plan, being a defined contribution 401k plan, is reached on an annual basis. Even if the employer decides to place profit sharing into the 401k plan account, many owners find that the 401k plan cannot get them to the level of retirement funding for themselves that they want, especially in the years when income is highest and when the owners want the largest deductions. However, a cash balance plan changes that because the cash balance plan is a defined benefit plan. And the defined benefit plan has higher IRS permitted contributions by the employer on an annual basis. So instead of being limited by employer annual defined contribution caps, the plan can also take advantage of a target benefit in the cash balance plan. And the actuarial funding requirements can allow significantly higher annual contributions by the employer, depending upon elements that are precise within your particular organization. So that actuarial funding has to take into account your particular organization's employees, the amount of their compensation, that's of both the staff as well as the owners. And taking all of that into account, then those actuaries can determine the amount of the actuarial funding as well as work with your retirement plan attorney to ensure the appropriate plan design. This combined strategy often leads to a larger total deductible contribution for the company than the 401k plan alone. So first, a simple tax illustration would be to compare a 401k only contribution, if taking into account employer and employee, over here in the blue on an annual basis. The maximum that could be placed into a 401k plan by employer employee for someone who is eligible to make 401k catch-up contributions, that is somebody who's age 50 or older, the maximum amount that can be deferred for that employee is $80,000 in a year. However, if we assume that this 50-year-old is working for a company that adopts a cash balance plan, and that cash balance plan is for a company where a significant portion of the staff is lower paid, the owners are much higher paid compared to the underlying staff employees. Every one of those employees will be receiving an employer-funded contribution for their annual funding as well as their interest. But all that taken into account would allow perhaps an additional $200,000 in the cash balance plan on top of the $80,000 for the 401k alone. So in all of this, you can see that the company itself would be able to contribute an additional $200,000 for that owner specifically. And if the company had an assumed tax rate of 37%, there could be an estimated tax savings of $74,000. Now, the feasibility analysis is also required. This is an important step that many organizations may overlook, and also where mistakes happen. You need a feasibility analysis, not a guesstimate. The feasibility analysis will include things such as your owner goals, the employee demographics, projected contributions by the employer, total employer cost, and multi-year sustainability. Workforce demographics can absolutely drive the cost. The cash balance plan must cover eligibility for employees, and the best fit for an organization is where the owners are older and have higher compensation compared to a younger staff that has lower to moderate levels of compensation. Also, the cash balance plan must be established where there is stable cash flow and a multi-year mindset. Cash balance plans require consistent annual funding, and this is under federal law. This is not a one-year tax deduction trick. The best results come when the plan fits a multi-year strategy. Coordination with a 401k plan design matters. Your 401k match, profit sharing, and any safe harbor matching design can affect the testing, which has to occur on an annual basis to meet IRS requirements, as well as taking into account your total employer cost. The two plans should be designed as a coordinated system and not as separate decisions. Also, governance and administration must be clean and is key to a successful cash balance plan. A cash balance plan will add actuarial work, funding range management, as well as additional IRS reporting. The business must be comfortable with that discipline. Cash balance plans which fit the particular companies typically include medical and dental practices, law firms, consulting firms, engineering firms, closely held businesses with consistent profitability, and owners seeking accelerated retirement savings and large current deductions, especially when the owners are in higher income years. Some practical next steps to determine whether a cash balance plan is right for your company is first and foremost confirm your existing 401k plan is optimized and compliant with existing IRS requirements. Our firm is uniquely capable of helping you to confirm that your 401k plan is optimized and compliant. Then you should run a 3 to 5 year feasibility study using your employee census and your contribution goals. Again, our firm is uniquely capable of assisting you in running this particular feasibility study. Then you would want to review the employer cost, not just the owner number. Because keep in mind, the employer must fund for all of the employees in the organization and then implement with a coordinated plan design, clean administration with a multi-year funding commitment. If I may provide you with any additional information, please email me. My email address is Lisa, that's Lisa, @cummings.law. Thank you for joining us today.